It has been a year since Sisa Ngebulana has been back at the helm of Rebosis. Probably it's 1 year that he would like to forget. The property group has been among the worst performers on the JSE in the last 6 months. Arrowhead plans to dispose of its stake. It is battling with debt and selling assets to try to salvage the situation. Well, so how do you get it back? The man himself joins me in the studio to discuss what must surely rank as one of his, you remember those famous words by the British Queen Elizabeth, annus horribilis? Does it apply to you, do you think?
Well, thanks for having me in the first place. I think, indeed, we're in a situation as a company where we've had a big investment in the UK, 3 big shopping centres in the UK. Since Brexit in the UK, you've seen devaluations of assets, especially shopping centres. Big shopping centre owners in the UK have handed back some of the big shopping centres. We found ourselves where we had to do asset write-downs. We lost in November last year about 3% of the value,
sure,
which reduces the net equity by almost 70%. So we lost the earnings of the UK and the income of the UK. We lost about 2.3 billion rand, which we had to write down in our results about 2 months ago. What remains beyond that is we still have a very good business.
Sure.
We have 17.5 billion worth of assets against a debt of 10 billion.
Sure.
Now that's 7.5.
This is both in the UK and here?
No, that's just South Africa.
This is now South Africa?
Yes.
Okay.
So if we forget about the UK business, what we said in our last results, we will exit the UK because that's got a big overhang into the share price.
Right.
If you look at the share price, Bs and the As combined, because we've got a dual unit structure, they make up only 1.5 billion.
Sure.
But if you look at our NAV, it's about 7.5 billion.
Sure.
So how do we realize that gap for shareholders? We have 7.5 billion of net equity in the business. And what we've said is we have 57% loan to value. That's the value of the loan of 10 billion against assets of 17.5 billion.
Gotcha. We
said we need to sell the first 3 billion worth of assets in order to drop below 50%.
Right.
And then another 3 billion, so in total about 6 billion rand, which will drop our debt to about 4 billion and our assets roughly around 11 billion. And will be well below the 40% mark, which is a generally accepted benchmark. A lot of REITs are above the 40%, but we want to be around the 40%, ideally below the 40%. That's really what we embarked on. And we've announced some asset sales, and they're going through the process in the meantime. And we're quite confident that that process is going well.
So I imagine some are looking at you like the knight in shining armor coming back to rescue the faltering ship. But in terms of what you are saying to try to unlock that value, some would argue that you are selling at the bottom and therefore you are losing value that perhaps necessarily you may not have had to lose if you had hung in there and just recorded your paper losses.
That's a good question. I think the key is we have a 50% loan to value covenant
that you need to
get below. So that's quite important for us. We need to ensure that while we're doing that, we don't lose value for shareholders. And losing value would mean we're selling assets well below book. We cannot afford that. So what do we have? We have many other options that are available at our disposals. So we've got, call it about 4 different options that we're looking at that our board has been approached for. However, the asset sale is straightforward. We announced it in the market. We're going ahead with it. In the event that doesn't work, and the only way if it doesn't work would be if we get prices which are not in line with our book or which are heavily discounted to book, because it doesn't help in reducing our loan to value.
Absolutely.
Then we'll look at the other options.
So could one say the answer to all of this is just asset sales on their own?
So the first answer for us that we put forward is that we'll do asset sales. There are other options, such as private equity, we've been approached for that, such as mergers, we've been approached for that, etc. So we've got many other options.
These are people from outside who are looking at your situation and thinking there is value to be unlocked here.
Indeed. So the first option for us on asset sales is what we believe is the best way to realize value for our existing shareholders. That's really what it is. Otherwise, we have a solid business, a very good business. What remains thereafter, after the asset sales, is a diversified portfolio of office with more office overweight. So what we've been doing since I came back on board is to improve the lease profile of the offices, because in an office context, lease profile is quite important.
Sure.
Our offices have outperformed our retail for years. in our fund. So it's not a bad thing to actually be left with our offices.
Yeah.
We've been improving, and we're about to announce another 8 transactions where we've concluded about 5-year leases across all 8 portfolios, covering over 100,000 square meters.
Yeah.
So for me, what's important is that while we realize the value and close in realizing that gap, we improve the quality of the existing of what we remain with going forward. We've, since I came on board, we've strengthened even the management team. So as a business going forward, it's really looking quite good.
Let's talk. I wanted us to talk about the profile that you're kind of looking at now. I guess people would want to know what kind of profile do you think would be appropriate going forward?
Yes. So we've announced 3 shopping center sales to Vukile, which is in Mdantsane City, and Blood Street Mall and Sunny Park, which is your lower LSM or low income shopping centers. That's about 1.8 billion. We've prior to that announced another 2 billion odd sales of offices. We have said we will be looking at disposing some of the retail as well in the space. If we do dispose of that remaining retail, we've been approached by a lot of parties, so we are negotiating with a few parties. We'll be left with about 30% of retail and about 70% of office. Now that office is actually quite a very good, solid office. With the long lease profile that we're looking at, it'll underpin our earnings for a good foreseeable future. But also it gives us a very good base going forward to rebuild the company back to our objective of being a retail-focused fund.
And I'm wondering what the other 40% is that remains in terms of the construction of that profile that you want to build. So you said 30% office, 30%
so 30%
retail.
will be retail, 70% will be office.
Oh, 70, sorry, I missed the number. Okay, cool. Time frames. People want to know when this will happen. And when likely will they see the kind of structure that you want that will be able to get the values that you're looking for?
So I think give us the next 6 months. I think it's quite important that in a market that's downturn, I think the entire property sector at the moment has been quite decimated. So it's tough. We're not operating in a market which is normal.
Agreed.
And whatever timeline you would put in a normal market would not apply in a tough market. And what tends to happen is that the prices you get in the market is what the other REITs can afford to buy from a forward yield perspective.
100%.
So it's a balance. But give us the next 6 months.
I wanted to understand actually how difficult those negotiations are because, I was talking to a friend the other day. They've got a business here in Sandton City and they were saying they were about to quit that business. And then the management of Sandton City came to them and said, you know what, guys, we don't want to lose you because it will change the profile of our Sandton City composition in terms of the people who are providing food within the shopping mall. And I'm just wondering how difficult it is for you as you are negotiating to try to sell these properties.
It's tough. It's not an easy market.
What
I think banks also have put
they're telling the screws.
The screws. So it's not an easy space to do. And that's why I keep saying we're not desperate. I think
these are not fire sales.
There's no fire sales. We haven't thrown our last dice. There's still lots of options that are available, which our board has assessed and said, look, let's pull back on that. Let's focus on the strategy. This is the right strategy in realizing shareholder value. It's the best way to realize shareholder value.
Absolutely.
There are other methodologies to do it. As I said, you've been approached for private equity and many other methods, which we'll look at if market gets tougher. But currently, I think we're going through with ourselves that we've announced. Office sales have taken longer because they depend on the tenants to renew those leases. But they're coming through. So, it's really just patience that needs to apply.
And the 6 months, is that becoming profitable or is that the return of the dividends?
So I think what's important is that we have an underlying portfolio in South Africa that continues to perform. We continue to pay our loans to the banks. We continue to be profitable as a business. So that's not an issue. All that happened is that we had to cut our earnings and cut our dividends to our shareholders in order to eliminate the UK. That's really what's happened. And then from a loan to value, we now have a much lesser asset base, which used to be over 20 billion, it's now 17.5 billion, which has given rise to the LTVs.
Does this feel personal?
I really enjoy. I think tough times are there to make us wiser and stronger. And for me, coming back, it's one of the challenges that I looked at, and I thought, well, I think I can do this. I believe in the company. I think we've got great assets in the company.
Sisa, we will look forward to welcoming you back here in studio to talk about the better story.
Thank you.
Sisa Ngebulana is the CEO of Rebosis.